Hello folks, welcome to Personal Finance. My name is Bryan. I work here at the Mansfield Branch of the DeSoto Parish Library. And today I'm going to talk a little bit about personal finance. Please, from the outset, I want to point out that I'm not a financial advisor. I don't have a degree in finance. I'm just going to talk about stuff that's worked for me over the years. I'm about to turn 59 in a few months, and this is just stuff that I've put to use myself. Based on articles I've read, books I've looked at, and I hope it'll help some of you out. Now what I'm going to talk about is 5 basic areas. Balancing a checkbook. I know it's very basic, but I don't know who's going to be watching this video. That might help somebody. Personal budgeting, spending, which will be money you're going to spend after you budgeted money for necessities. The one I really like to talk about, investing for the future. And at the end, I'd like to say a few things about Social Security, when to claim it, things like that. All right, let's start off with balancing a checkbook. Now, here's my checkbook. Nowadays, I don't know about you, but I hardly ever write a check. I probably write a check maybe once a month. But I think it's important to have a checking account. You can call it a bank account, even if you don't write a lot of checks, just because it's handy to have. I know that my paycheck gets deposited directly into my bank account, my checking account, so that's good to have. Things like my utility bill are paid directly from my checking account every month. It's just an automatic withdrawal each month for that. So it's a good thing to have. Now, the reason you want to balance your checkbook is you want to make sure that what you're showing in your check register, that's this little thing. Your bank will give you this. It's just you use it to keep up with all your transactions. You want to make sure that the amount of money you're showing in your register pretty much matches what the bank's telling you you have. So whenever you're writing a check, if you're writing a check, right here you got an item number. I always write my check number there. You've got the date that you wrote the check, a brief description of what it's for, and the amount. Now that's in the debit column. Now if you're getting any additions to your checking account, which are always nice, stuff like your paycheck, if somebody wrote you a check for your birthday or something like that, it goes in the credit column. And then you just keep a running total, subtracting from what you're showing you have in the bank, subtracting each debit from that, or adding stuff like paychecks if that's on a credit. Now when you balance your checkbook, every month your bank should send you a statement, or I get mine online. Here's one month I did for my savings and loan. And it's going to have the date on it and each transaction and the amount. So what you want to do is, in your check register, keep a running total of your balance. And you want to make sure your balance, as of the date the bank sent you your statement, balances, in other words, is the same amount. So you'll add and subtract everything in your totals over here, depending if it's a debit or a credit. And you want to make sure that what you're showing is what the bank is showing. Now, if it doesn't match up, you want to take into account things like an outstanding check that hasn't been cashed yet, maybe a credit card payment you had sent off, but it's not time to pay it yet. In other words, if you're paying your credit card online and you set a due date that's after your checking account statement, that may not have showed up yet. So if your balances don't match, go back and try to account for what's missing. Now if it's, like I said, a credit card payment, you want to add that in to what the bank's showing because they haven't deducted it yet. Check your addition and subtraction in your own register. You may have made some mistakes there. Check each transaction and make sure that you've written them down in your check register. You may have missed something. And that's just a monthly habit to have to make sure you have in your account what you think you do. And there's not a whole lot more to say about that. Pretty basic stuff, but some of you may not know yet. Let's go on to budgeting. I think it's important to invest what you can of your money, but you're going to need some money pay off your expenses every month. So it's a good idea to know how much money you're going to need from month to month for basic expenses. Necessities. Here's a few of those things. A mortgage on your house, car insurance, house insurance, your utilities, your phone bill, internet bill, if you have trash pickup, if you live out in the country, what you're paying for that. Your TV, whether it's satellite, cable, streaming services, groceries, any clothing, health insurance. Now health insurance, if that's already being deducted from your paycheck, if your employer's providing your health insurance, that's already deducted automatically, so I wouldn't include that in that case. Prescription drugs, if you're getting those on a regular basis. Groceries, haircuts, what you spend on haircuts, child support, if that applies, alimony, tithing to your church, anything like that. So for a month, maybe 2 months, take a sheet of paper and list what you're paying for each one of those items. Now on something like utilities, we live here in the South and that can vary, especially in the summer. As you know, it gets hot, your utility bill is going to be the highest it is for the year. So I think you can contact your utility provider and maybe get a monthly average so that you can average it in every month, and I'll give you a better indicator. So stuff like groceries, keep your receipts as you're doing this, working out your budget, keep them for about a month. See what you're spending on groceries and add that up. Now, you want to add all that up and save that money aside each month. Make sure you have it so that you can take care of those expenses. Now, after you have money set aside for all your expenses, hopefully you'll have enough on hand to do some investing. Now let's talk a little bit about a college fund for those of you that may have kids. If you want your kids to go to college later, okay, you might want to set some money aside to put in a college fund. Now there's a well-known finance guy, Dave Ramsey. This is a book of his that we have here at the library, and we carry some more. Here's what he recommends for a college fund. There's something called an education IRA, which if you put money into that, it grows tax-free if you're going to use it for college. He recommends putting at least $2,000 a year into that. Now, speaking of books, I'm going to backtrack a little bit. We got plenty of finance books at the library. If you're looking for a specific book that we don't have, we can get it for you, either from another branch or outside DeSoto Parish. But I already mentioned Dave Ramsey. Here's one, The Dumb Things Smart People Do with Their Money, Retirement Survival Guide, all kinds of stuff like that. So come by the library, check it out. Now spending, we've talked about budgeting. Spending is what you may use your money for on anything other than necessities. Wants, not needs. Things like dining out, taking a vacation, entertainment, going to the movies, anything like that. Now on spending, well, I'm going to think ahead a little bit here. Investing, to me, for the future is pretty important. I've always put a high priority on it for retirement. You're going to need some money to live off of once you retire, and the sooner you start spending, sooner you start investing and saving, the better, because you're going to be earning interest on your money. Then you have compound interest, which is earning interest on your interest, and that just grows and grows. Slowly, it could be slow, but there could be some downtowns. We'll talk about that a little bit later. But the sooner you do it, the better, and you got to decide how much you want to put towards that. So when you're spending money on, I don't want to say frivolous things, but things other than necessities, I like to keep that in mind. I like to consider something called opportunity cost. Now that's a fancy economic term. All it means is what you're giving up in order to acquire something else. In other words, if you want to go buy a new car, then what else could you have used that money for instead of that car? And you got to consider that you could have been earning interest on that money instead of buying the car. There's that expense, plus insurance, plus financing if that applies. Now if you need a car, you need a car, but not just a car, but when you're buying something, but think, how much do I really need this? How much joy will it bring me? I try to always think like that. The answer is different for every person. Like I say, if you need a car, you need one. What kind of car do you need? Here in the South, it seems like every other vehicle is a Toyota Tundra or F-150. Do you really need that big truck? If you do, you do. If you're hauling a lot of stuff or pulling a lot of stuff, then you need that vehicle. Maybe not. You know, consider that if you get even a smaller truck or a different vehicle, what else you could do with that money. Now, when spending, of course, credit cards are a big thing. I started to say don't use them, and I changed my mind on saying that it's important to use a credit card, at least some, because you need to establish credit. In other words, if you get ready to buy a house, even buy a car, they're going to look at your credit rating, which is how well do you pay off your debts. So if you use a credit card, even if you pay it off in full every month, which I think is a good idea, then you can develop that credit rating, which will be good. You know, credit cards, the temptation's always there, you know, to spend frivolously, and if you can resist that temptation, then having a credit card, I think, is a good thing, mainly because I make money off of mine, paid off in full every month, and there's rewards. Excuse me. The card I have is the Capital One credit card, and gives 1.5% back. Now, I'm not a spokesman for Capital One, but I'm putting that out there. And so you can use these points you accumulate to get cash back or credit towards your credit card bill, gift cards, you know, stuff like that. It's pretty nice. So, you know, consider how much you want what you're buying, and consider what you're trading off to get it. Let's talk about investing next. This is what I really like to talk about. Now, simply put, and this is simple, investing is letting your money work for you, putting it in some kind of account where it can earn interest for you, and you can use it down the line for retirement or to buy a major purchase, like, I don't know, a boat. You know, I've heard the happiest you are with a boat is the day you buy it, and then the day you sell it. I don't have a boat, so I can't comment on that, but you know, mainly for retirement, I would think. Now, what do you want to invest in? Now, I would say the first thing to invest in, if you're working and you have an employer that offers some kind of employer-sponsored retirement plan, like a 401k, then to take advantage of that. What that is you put some money into that fund, let's say a 401k, and the employer matches it dollar for dollar. Generally, I've got two of them from two other jobs. Generally, the first 6% they will match. Now, folks, that's just free money, that money that they're matching. So, you know, it's great. So if you put your money in there, let it grow. Now, what is a 401k? Basically, they're investing in different stocks. It'll be a fund. It won't be a single stock or even just a few. It'll be several. So that if one stock takes a downturn in the market, others may bring it up. Overall, the picture is going to be pretty good. There'll be a gain. So again, it's just free money if you participate in that. And I really strongly believe in investing in that. Now, here at the library, we've got something similar called a 457. It kind of works the same way, really. It's a match. Now, investing beyond 6% for that's up to you. Something to look into, maybe, but definitely the 6%. Now, the nature of the stock market is it's going to go up and down over time, but overall, you're going to have a gain. So when those markets start tumbling like they are now during the COVID-19 crisis, at the time of this taping, you know, it can be a little unnerving, but if you are not taking anything out of that account, you are not losing money. I learned that lesson back in 2008. Some of you may remember we had the Great Recession, or a big recession, and I would get my statement every month and tell my wife, look, I'm down $1,000 this month. And she had to remind me that I wasn't down anything because I hadn't taken any money out. So it was only down on paper. And then I think it took us 2 years to pull out of that. But then it came back up heavily, and things got back on track again. So that's a good thing to invest in to begin with. Now, a lot of times in a 401k, depending on your employer, you can pick your funds. They may present you with a list of funds to look at, and you can choose what you want. That can be kind of daunting, I guess, but what I like to do, I have one 401k where I would do that. Once a year, I have the opportunity to pick which funds I want to be in. And I look at how each fund has performed historically, in other words, with the highest returns. And I also look at, for each fund, the expense ratio. Now, what the expense ratio is you are getting charged for someone to manage these funds for you. The general consensus is if the expense ratio is below 1%, then that's pretty good. In other words, if you get charged less than 1% of your money that you have in the fund, then that's pretty good. So I look at that, and then you pick your funds. Now, some 401ks offer a target date fund, and what that means is as you get closer to retirement, the fund managers will allocate your investments more conservatively as you approach retirement. In other words, they'll invest in maybe bonds instead of stocks, something a little bit less risky, so that when you are approaching retirement, like within a few years of retirement, you have less chance of losing some money. You just pick your date or estimate your date that you're going to retire and enroll in that fund, and they will do that for you. So that's an option. Now, other than 401ks, what else can you invest in if you have any money to spare? IRAs are a good thing. Now, there's two kinds. There's a Roth IRA and a regular IRA. Now, in a Roth IRA, you put your money in it, and it grows tax-free. Now, if you have a high income, you may not qualify to enroll in that. So I would check into that before enrolling into an IRA. It's got to be pretty high for you not to qualify, though. But in a Roth, your contributions grow tax-free. Now, in a regular IRA, you put in money that's taxed, has been taxed already. And then once you pay your taxes on it, you put that into a regular IRA. And you pay taxes on your gains when you take it out. Now, the advantage there is hopefully, like if you're doing it for retirement, hopefully you'll be in a lower tax bracket and not pay lower taxes when you take it out. So that's two kinds of IRAs, something to check into. Now, besides the 401ks and the mutual fund or the IRAs, there's something called a mutual fund, and I really like those. I've been in one for several years now, and I like it. Now, the stock market can go up and down, and when you get those statements with a negative return, it can be scary. But just keep in mind that if you've ever been through that, then you know the market's going to come back. Now, you can check a website called Morningstar. That's one word, Morningstar. And you can review different mutual funds, get information on them, how they're ranked, what different people say about them, the historical returns, articles on how the fund's doing, all kinds of stuff like that. A very helpful website, Morningstar. I like mutual funds to put money in for retirement, again. Okay, and I've already touched on getting more conservative with your investments as you approach retirement. So that's a little bit about investing. Let's talk about Social Security a bit. Now, Social Security is a interesting beast. I'm not claiming it yet. I'm not old enough. I'm a few years off from even claiming it at the minimum age. But the big question with Social Security is when to take it. There's a lot of factors to consider on that. A lot of people think that Social Security is on its way out, that it's going to crash. that it's in trouble. Now, everything I've read about it is that it's going to stick around, but it does have some problems. Now, of course, as most people know, the way it works is people that are working, they have a Social Security tax that they pay. They pay half of it, and their employer pays the other half of the tax at each pay period. Now, that money is going in, but the system is going to be out of reserves. They're estimating now by 2035. Now, what that means is anything they have above and beyond what they're paying out, that extra money, it's going to be gone, unless some changes are made. Now, what kind of changes need to be made? The government's looking at a lot of things. They're looking at increasing the Social Security tax, cutting benefits to recipients by different percentage points, or a combination of both of those things. And they're looking at cuts based on a person's income. If a person's income is really high, they may cut those benefits and leave some people alone. It's all up in the air right now. And whatever any politician does, it's going to make them unpopular because it's going to make somebody unhappy. But as it stands right now, nothing's being done. So that's something to consider, I think, when you're planning on when to take your benefits, because you may start taking your benefits thinking you're going to get X amount, and then later some cuts come along the way. But if you had taken your benefits earlier, before those cuts happened, you might have been better off. Right now, there's no telling when they're going to do anything. Now, you can start taking benefits as soon as age 62. And I'm not talking about disability. This is strictly plain Social Security. But at 62, and you can take them as late as age 70. So when do you take it? I think probably most people, or a lot of people, take it at 62 because they think the system's in trouble, want to go ahead and get their money. There's a lot of things to consider. I mean, if you really need the money, you might want to take it as early as 62. Now, keep in mind that Social Security was never devised to be strictly a retirement program. It was meant to supplement any other money you might have or have saved. It does help. It's a good thing. But it's not meant to strictly be the main source to support you. But if you really need the money at 62, you might start taking it then. If you've got some health issues, you might take it then. But here's the thing. For every year you wait between 62 and 70, your benefit goes up approximately 8%. Excuse me. Now, that's pretty nice. Now, beyond 70, there's really no incentive to take it any later because there's no increase for each year you wait after 70. But between 62 and 70, every year you wait, it's an approximate 8% increase in benefits. Pretty nice. Now, here's the thing about that, though. Let's say you decide to take your benefits at 64. Well, you have your benefit, but you also have 2 years when you're 62 and 63 that you didn't receive any. So you've got to go a ways in receiving benefits to catch up to get that money that you didn't get when you were 62 and 63. That's called the break-even point. That's the point where you're going to reach making up for those previous years that you didn't get any money. Now, how long does that take? It takes longer than I would have guessed. It takes between 8 and 10 years to catch up. So, you might keep that in mind. No one knows how long we're going to live. You might want to take it earlier for that reason. Just a lot of stuff to consider. Now, if you wait till 70 to get your maximum benefit, and it takes you 10 years to reach that break-even point, in other words, to catch up and get all that money that you didn't get by claiming earlier, you'd be 80 years old. Now, that's up there, so something to consider. One theory that's out there, or outlook, is to not look at Social Security as something to live on, but as old age insurance. And that was an interesting article I read. point of it was, if you happen to live well into your 80s or 90s, 100, then if you wait till 70 and you've got the highest benefit possible, you pass your break-even point at 80, then you're making the most money you can from Social Security from that point until your death. If you think you're going to do that, if you think you're going to live well into your 80s or 90s or longer, then that might be something to consider. Now, keep this in mind. Whenever you take your benefit, whatever age, that benefit is what you're going to be receiving for the rest of your life. Now, that's not accounting for cost of living adjustments, which the administration does quite a bit, to keep up with inflation. But basically, your benefit, that's what you're stuck with for the rest of your life. So it's a lot of stuff to consider on Social Security. So I hope that I've covered some things to at least make you think, maybe something you hadn't thought of for a while. I hope some of this was helpful. Now, I would like to say that at the time of this taping, we are experiencing the COVID-19 pandemic, and it's floating around. And I realize this won't apply to some of you. People are losing jobs. If you just lost a job, you can't be worrying about some of this stuff. I really hope that you're able to get back on your feet soon and be able to apply some of this stuff, if that's the case. If you're young and just starting out in the workforce, or if you're a young couple, this stuff will be hard to apply as well. But I hope that over time you'll be able to put some of these principles at work for you. And again, remember, there's all kinds of books here at the library. Anything you need, if you have something in mind, give us a call and we will get it for you. My name is Bryan. Again, thank you, and thanks for listening.